Okay, it is 11 o'clock. We can get going. So good morning, everybody. Busy show today because it's the first of the month and we've got Andrew McHattie running through what happened over the course of October. And then I'm going to hand over to Richard Williams, who's going to be interviewing Bradley Biggins of Schroeder Real Estate Investment Trust. So news first, a few things to pull out there. I'm going to start with Bluefield solar income. We all talked about this last week, so it should be fresh in your minds, hopefully. And the share price has only just carried on going down for various reasons, one of which we're going to talk about later. So the discount is now heading towards 35%, and the notional yield 12 if it's still around to pay those dividends. So the board has now decided, having had some feedback on the proposals that we discussed last week, that it will simultaneously launch a strategic review and invite bids for the company. So that puts it into an offer period. And the manager says it will put itself up for sale alongside the trust. So we don't get the situation where the trust was going to buy the manager and you have this huge fight about is the trust paying a fair value for the manager or not. Understandably, I think, because this is what we were saying last time, the shareholders didn't really like this idea. And so we get rid of all of that. So somebody, if they choose to, can then buy the trust and the manager at the same time and combine the two afterwards. Or alternatively, they could just try and buy the trust. We'll see what happens. So because the way this is all structured, we won't see who's bidding until the board's ready to announce it. That's just one of the wrinkles of the structure. But anytime somebody can come in and just throw a public bid in to the mix, so we won't rule that out that somebody will actually declare something while we're going on. So that's all good fun, and hopefully it result in a much higher price for shareholders and something closer to NAV, but we'll have to wait and see. Ecofin, I'm going to mention very briefly. It's tiny, and I know most of you don't really care anymore, but it has been in this managed wind down process for a while now. It has already handed some money back to shareholders. One of its big assets that it's still got left is its Texan wind farm, which is the thing that caused all the problems. So if you remember, a tornado came through and managed to spare the actual wind turbines, but cut the power line. And they haven't been able to repair that since. So this thing was $29.9 million out of $56 million of assets left at the end of September, end of June rather. And so they've agreed to sell it, but the way that the deal is structured, it's quite scary, really. So remember, this thing's had $30 million. They're only going to get $12 million up front. They're also going to get another chunk of money based on the number of turbines that get upgraded to higher power output capacity. But these also need to get production tax credits. And there's obviously debate about whether that's going to happen or not because of what's going on with the politics. But obviously they're hoping they will do. They've got until 31st December 27 to get all of these upgraded. If they can do that, they'll get $7 million. So that makes it up to 19. And then the balance of all of this is held in an escrow account, $11 million. But that falls for every month that the wind farm cannot generate the power cannot export the power that it generates. Now, the problem here is the line, because it's had problems. So they're going to get a reduction in the value of this escrow amount that accelerates as time goes on. So if it's fixed by 1st of January, there's nothing. If it fixed during January, they lose $13,200 a megawatt for the amount that's kind of curtailed by. If it's not fixed until 2027, all of that money's gone. So you can see the danger here. So as I said, the old line didn't get replaced. The temporary line's been unstable. That's why it's been curtailed down to 30 megawatts. And when they announced the interim results, they said that they're hoping to get all this fixed by the end of 2025. So what I don't get, this is fundamentally, I don't understand, is why would you do this really complicated deal with a really uncertain outcome? Because anything can happen, we'd have another tornado or something, and God knows. So why do it this way instead of just waiting till you fix the problem, hopefully only for a few more months, and then selling it? But there we are. That's the situation. So hopefully you're still not shareholders. Jemmy, I wanted to throw a good news story into the mix here because otherwise it just has me miserable all the time, and I'm about to be very miserable. So this is a good news story. It's something I hold, something I love. It's the discount's still too wide. Shouldn't be 10.6. It's doing very well. The results that came out today, tick, 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 it's outperformed both in NAV and share price terms. That just extends its leads over the benchmark over 5 years. Dividends going up again. That's been going up every year now since 2020. And it's generating the income naturally. So that dividend is covered by earnings. And they've built up revenue reserves since they started about equivalent to about 1 year's income. So that means that if there's a problem, they should be able to keep the progressive dividend going. They've also been buying back stock because the discount's too wide, and that's added to the NAV. And they instituted a performance-triggered tender if it doesn't beat the benchmark for 5 years. So I think this is doing all the right things. And importantly, the reason why I'm banging on about it really is because we've got this sort of shift for the JPMorgan emerging markets, where it's shifting to paying income out of capital based on the percentage of the NAV, which a lot of other JPMorgan funds do. I think it would be a total disaster if the board said, oh, I know, let's just knock these two together now because they're both income funds and they're both in emerging markets. This is a very different portfolio. It's run in a very different way. It works, and the other one sometimes works and sometimes doesn't. And I don't want to see this disappear. So now, the reason I was going to be miserable, subsidies. So the government just sort of fairly out of the blue, I think, has come out and said we want to change the terms of our arrangement for subsidies. And so we're launching a consultation, which will be open for a month. And it's all about changing which inflation rate is used to calculate the amount that they pay under the subsidy for renewables obligations and for feed-in tariffs. And we want to make the change by April 2026. Now, this is a scheme that goes all the way back to 2002. If you remember, David Cameron said no more subsidies in 2017. And so it's closed to new subsidies already. And they're all for a fixed period. So they start to roll off from 2027. And by 2037, there won't be any more subsidies. So this has got sort of natural end date anyway. And because it's been pretty successful, they now actually support an incredible 30% of the generation capacity in the UK. So it's a sizable thing. Now, everybody knows, well, I mean, this is sort of nuanced thing, so maybe most people don't care, but there was a problem with RPI. The way it was calculated, it sort of, it was with a higher number than it should have done. And so the Statistical Authority said, we're going to replace it with CPI, including unoccupied housing cost, CPIH, and that's going to be our main standard for measuring inflation in the UK. And it said that we won't even bother calculating RPI under the old methodology from 2030. We're just going to shift it, keep it the same base, but shift it to the CPIH methodology. But the government spotted that there's a gap, and I'll show you how this works graphically. So it's a fairly big gap. And they're saying, well, because we've been using RPI rather than CPI, then they're talking about CPI, not CPIH, which is a different thing. This has just mean that generators have been overcompensated for the effect of inflation. And this is true, but we always knew it was an issue. It's always been reflected in NAVs. It was something that the government got wrong when it set the whole thing up, but it's contract. This is the situation. And people who've been buying and selling these investment companies all the way through, so, for years and years, have always known what the terms of the contract was and the amount of money that there was going to come to them, and this is all reflected in the NAVs. So this is how the charts work out, and you can see the gap between RPI and the two CPI measures there. Shifting to CPIH, which is something that I originally thought would be, it makes more logical sense if you're going to shift it to CPIH rather than CPI because it's more equivalent to RPI. But I still, there's no logical argument for changing the contract now, I think. So, but what they're proposing is, it's not like we're saying, we think maybe we've mucked up here. So do you think, we should make the change? They're saying we're either going to penalise you or we're going to really penalise you. So we're going to switch to CPI from 2026, which there is the grey line going on to the green line. Or we're just going to stop uplifting the subsidies at all until they get to a point where they would have been if we'd been using CPI all along. The logic, I just think that's completely wrong. There we go. It will obviously save money because that's the point of it. They have been paying too much. So about £180 million in the first year, rising to about £460 million in 2031-32. And they're trying to say, we're doing all this for consumers and it will lower electricity costs for consumers. I believe that when I see that, really, because obviously the government's desperate for money, and maybe this is part of the reason they're doing it. Now, there's an obvious hit to the NAVs of the trusts involved, and you can see what those are there. So under the first option, the hit isn't too bad, really. Worst affected there is Next Energy Solar, according to Investec estimates, and Next Energy hasn't actually said how much they think the hit would be yet, but the Investec estimates weren't too bad for the others. On option 2, the worst hit is Bluefield Solar, 9.5% hit to NAV, which is really quite chunky. And I think they're basically, it's like a sort of stick and a bigger stick approach where they're basically saying cave into option 1 or you'll get option 2. So this is what the consultation says. So obviously, if you look at question 1, it's like, is a fairer and more accurate measure of inflation? Yes, it's hard to disagree with that. And then it's saying, if you choose between the two options, which one would you choose? And obviously, everybody's going to go, well, option 1 works out better for us, so we'll have option 1. And then they say, well, what are the impacts on generous consumers and investors? And what alternative approach should be used? And the obvious approach to that is don't do anything. So I put the contact details in here because obviously I quite like to get some of you fired up and write into these people. But the biggest thing with all of this is it doesn't seem like a lot. And yeah, maybe we could wear it as an industry and, all this sort of thing. But it just creates this precedent that where the government mucks up when it does something, it can just change its mind and impose a new set of conditions on the contract. That's really dangerous, especially if you get a government that comes in and says, we should never be paying subsidies in the first place. You've got to pay all these back, or we're just going to stop paying them, or that anything might happen. And because it creates this risk that anything might happen, inevitably, anybody that contracts with the government in the future is just going to say, well, I don't trust you, so I actually want a higher return. And because we need so much infrastructure investment in this country and the government can't afford to pay for it, we're going to need that private capital to come in and finance it. And if all of them are saying, but we need a higher return now, it's just going to cost way more money than they're going to save by doing this. So I just think it's a really daft idea. I mean, to give you, we keep banging on about our industry and what we've done for infrastructure investment in this country, and it is significant. But just as one example, just this week, INPP said it inked its deal to help finance Sizewell C. Whether you think that's a good idea or not, I don't know. But but basically, if you want to get Sizewell C built, you're going to need private capital. INPP is putting up some of this. It's doing it, as we discussed on a previous show, on the basis of a contract that actually gives it a pretty smooth deal, I think. It's all inflation-linked money, and it does seem to be all completely risk-controlled. But, it just creates this uncertainty that somebody will come along and say, well, actually, this is too sweet a deal, and we shouldn't have done it, and we're now going to change the goalposts. And, that's just really bad news. So there we go. Please do go back to that page and write to the government. So I'm now going to hand over to Andrew McHattie.
Thank you very much, James. I'm just going to do my slot here before I get writing to the Department of Energy, and I think that was you're exactly right. That was a subject well worthy of a little bit of grumpiness, because it does seem extraordinary that the government is moving the goalposts, as you said. Still, we'll have a bit of brighter news now, and talk about what's happened during the last month, and these are the risers. Now, I think there's quite a good smattering of different things here. So quite a range of trusts. You can see some biotech trusts in there because there's been good news and lots of M&A there. We can see Schroeder Real Estate, so we'll be hearing about that one. There's actually Gore Street Energy Storage Fund on there, where there's a lot going on in corporate terms. Both Saba and RM are pushing for further change there. And SDCL Efficiency Income, where Saba has a stake. And then there's some other things as well, including a couple of Japanese trusts on there, because we've seen a change of government in Japan and lots of positivity around that. So actually lots of really interesting things going up. And on balance, actually, the market was up and down over the month, but we did have a small net gain. So hopefully some of us have made a little bit of money. I will talk about RTW Biotech opportunities, because I think that has a couple of unique and interesting aspects for me to talk about. On the way down, we do have actually quite a bit of energy infrastructure on there, partly for those reasons James has just discussed. But generally, there wasn't too much going down over the month. We can see a little bit of a contraction in a couple of the commodities trusts there, including Gold and Prospect Precious Metals, which has been top of the risers for the previous 2 months, because we've seen the gold price just come off its peaks for now. But I think it's quite interesting. As I said, a lot of energy infrastructure. And I really think this potential shift in the subsidies is kicking the sector while it's down. And there's so much uncertainty now. We've seen Bluefield obviously putting itself up for sale as a result. So we'll have to see what happens. I think that sector is going to be in the news quite a lot over the coming months. A couple of other things that I've highlighted here. The ones in red are the ones I'll talk about. A couple of trusts I think that are perhaps surprising to see on the list of fallers. That's Nippon Active Value Fund and HG Capital Trust. So I'll talk about those two and why those might be interesting now. So RTW, first of all, I think this is a trust that has been on the market for a few years now, and it has changed its spots a little bit as it has matured. But I think in many people's minds, they still think of RTW as a very early stage biotech investor, and therefore a high risk trust that should be trading on a suitable discount that is sufficiently wide to reflect those risks. But I do think actually RTW is doing a decent job of explaining that it's a full life cycle investor. So it does make early stage investments. And when I say early, I mean really early. So sometimes it will actually form its own companies if it sees an opportunity in a therapy where no one's currently working, and they'll actually put a company together, find the executives and build that company. But they hold those kind of stocks, but they keep holding them right the way through to maturity, beyond IPO, until they feel that all of the value has been realized. And actually what's happened over time is that, of course, the portfolio has matured. So it's now made up of a higher proportion of listed mature companies than it was before. So it's about 30% unlisted now. which is considerably different from where it stood a few years ago. So I do think on that basis, there's a case for narrowing the discount differential when you're comparing RTW to the two other biotech trusts, so Biotech Growth Trust and International Biotechnology. But if you have a look at the chart on this slide, the discounts don't look that unreasonable. So we've got the Biotech Growth Trust on 7%. We've got International Biotechnology Trust on 11.5%, and RTW Biotech Opportunities on 14.6%, apparently. Now I say apparently because that's not the real discount. So let me explain that. The key here is that, and this is really historic because so much of its portfolio was unquoted, RTW still releases its NAV on a monthly basis. So that discount you're seeing there is on the basis of the last released NAV figure. So that was actually the end of September. And that's out of date because quite a lot's happened since then. So that's based on $2.12 per share. But since then, actually, RTW has benefited from the takeover of Avidity Biosciences. That was a big holding, its third largest holding, and it came out, or the bid was at a 46% premium to the prior share price. So that was great news. But equally, there's a company called Unicure, which has fallen back very sharply. That's a sad case where the company announced a really major breakthrough for Huntington's disease. And now the FDA has pushed back and said, actually, you don't have enough data for that. So we're going to hold back on that. So there have been ups and downs here. And there was another up this morning, actually, when RTW announced that another portfolio holding, this one called Evoimmune, has managed to IPO in the US. That's 1% of assets, and the IPO was at a 20% uplift to the prior holding value. So more good news. There's a lot of moving parts with RTW, and I try to keep track of those. So I have a spreadsheet actually which tracks their major holdings. And as of yesterday, that was showing me that the NAV was actually up to $2.26 a share. I think it fell last night by about 3 cents. But that implies the discount is wider than we saw in the official Morningstar data there. So I think the discount's more like 19.8% here. So maybe that's interesting and one to have a look at. Let's move on to a couple of things that have dropped. Now, I'm a bit perplexed by this one, and I might just be out of the loop in the news flow, but I've tried to discover what's happened here, and I haven't really found out. Generally speaking, it's been a good month for Japan. There's been lots of great media coverage. The market seems actually pretty pleased with the new Prime Minister, Sane Takaichi. And I do think, actually, it's been a generally bright month for Japanese equities. The Nikkei 225 index is up 6%. But Nippon Active Value Fund, which does have a very concentrated portfolio, that's down by almost 10% in share price terms, not in NAV terms, over the month. And this chart here is a short-term chart just showing you the share price of Nippon Active Value in black against AVI Japan Opportunity in blue. That's a similar trust in many respects, based on a similar kind of thought process about the evolution of Japanese corporate policy and the more shareholder-friendly approaches that they're trying to promote. And those two have moved in tandem for actually quite some time. But you can see here there's been a real break. So Nippon Active Value Fund has broken that correlation and now looks considerably cheaper. The same is true if you look at the discounts. So AVI Japan Opportunity actually on a very small premium to its NAV, and Nippon Active Value Fund has now dropped to an 8.5% discount. I think today it's slightly lower than that, but still about 7 to 8%. So a significant differential has opened up there. And the same is true if we look at Nippon Active Value's current discount compared to its own history. So this chart is a chart showing you the share price in blue and the NAV in green. And you can see actually there have been moments before where the discount has opened up. So at the start of the year, in the first quarter of the year, a discount did open up, then it narrowed again. And for the last few months, this trust has been trading very close to NAV. So this does seem to be a significant shift. I've really tried to find out why, and I haven't been able to. So it's, I think, worthy of further investigation, and we'll see if there are any other developments to come there. It could just be that there's a big seller in the market, and that's not the share price. HG Capital is the other trust, the last one I'll talk about. This is well known as a very high quality private equity trust that really does have a fantastic track record. If you look back at any long-term statistics for the sector, HG Capital is very prominent near the top of the risers. Over 10 years, it's the fourth best trust out of all sectors in share price terms and fifth in NAV terms. So it really is one of the greats of the sector over that period. Very highly thought of. And for this reason, generally the trust has bucked this trend that we've seen for private equity trusts to be on wide discounts. HG Capital Trust has actually traded reasonably close to NAV for a while, but that again has shifted over the last month, and the discount has widened out. So it's come out to 13%. You can see from the chart there that there's no change in the NAV. In fact, that's slightly out of date, and the NAV is now 550 pence. So it's 10 pence higher than on the chart there. So we have fresh data. We had HG Capital's third quarter figures showing this 2.4% increase in NAV, more positivity around the underlying performance of the assets held, the underlying portfolio companies. So I don't see any problems there. And in fact, there could be some good news on the horizon. There's talk about a potential IPO for Visma next year, which is the trust's largest holding. So potentially some good news to come. If anything, you might think that would foster a narrower discount NAV. So it does seem surprising to me that this has opened out. And I have noticed that the market has reacted, that there has been quite a bit of coverage of this. So Stifel stockbrokers, for example, have upgraded the shares to buy. And I'm obviously not giving any advice on here, but I do think it's worth considering if you're a long-term investor looking for some quality in your portfolio. So that's it from me on the movers. I'll hand back now to James or Richard to talk about property.
Brilliant. Thank you very much, Andrew. I don't get the Nippon active value thing either. It's a bit weird. I mean,
it does seem curious.
There are, it does feel as though there's the odd sort of person just selling stuff, sort of not really worrying about prices. I give you never. Sometimes there is like a big seller out there, and you get some weird moves, but yeah, we shall see. Right, so there is the very important disclaimer.